So the big question right now is that if you're looking at your bond portfolio, and let's just say that you have high grade securities, let's just use A rated or better as an example. And you're looking at your portfolio and you're going, okay, I don't really understand why my bonds are down because you've seen equities get hammered over the last several weeks. And one would think that it would be a flight to quality. In other words, people moving out of equities and going into bonds, high grade securities, whether it's corporates or munis or a combination of both. And so the reality is that when we're in school and we learn about bonds versus stocks, and the typical textbook is that bonds are inverse to, say, stocks going down, so it's a nice haven to go into, etc. Normally it works that way. However, when we have a market dislocation or a lot of uncertainty, as we've mentioned before, that automatically, that kind of is thrown out the window, meaning that not necessarily the bond prices are going to continue to go down, but yields overall, keep in mind, yields are inverse to pricing. So as yields go up, prices go down. Yields overall have moved up over the last, say, 2 to 3 weeks. The 10-year Treasury, as a great example, currently is trading at around a 430 to a 435 at the time of this recording. It got all the way down to a 3.8 to a 3.85%. And what does that really mean? That really means that that's what's called a benchmark securities that really prices a lot of other securities, primarily in the corporate world, but the municipal world does price off of the treasuries as well. So as the yield went up on the treasuries, call it a 380 to a 430 as an example, then pricing went down. Why did that happen? Why is this going on? The reason being is because we have a tremendous amount of uncertainty about what's going on in Washington, our political environment right now. And I'm not blaming it all on political environment, but with the tariffs going on, there is a concern of an inflationary problem that's brewing in the background, to where if it costs you and me 30, 40, 50% more to buy whatever, a TV or a car, or for that matter, maybe groceries, then all of a sudden you're going to start to pay more, which impacts fixed income securities. Impacts meaning that you're getting a fixed rate, 5% as an example, and it might cost you more money to buy products at the store, but that 5% stays static. So therefore, the price of that bond, the price of that instrument is going to go down because it has to adjust the yield with what's going on in the system. That all sounds great and good, and it's maybe complicated, maybe it's not complicated, but the fact of the matter is that we're seeing fixed income securities at this moment in time continue to get hurt, continue to go down in price, because they're adjusting for these tariffs that might cause inflation. Adjusting, might, those are two real interesting words to use. They're adjusting because there might be something happening. This goes back to the uncertainty we spoke about. It goes back to the overall thought that what is the market going to do? Will the tariffs hold? What's going to happen with China and how that's going to impact you and me? So with all of that said, that's just a quick down and dirty as far as why munis are trading the way they're trading, why high grade securities are trading the way they're trading, is because the underlying issue might be inflation. It might not. But if your time horizon is long, and if you're looking to add liquidity, add good quality securities through any liquidity you have now, it might be a good time to speak to either us or whomever to get an idea of what's going on and what's out there for sale. And not only that, but where those securities were trading, say, 3 to 6 to 12 to 15 weeks ago. That'll put it a little bit more into perspective. Hope that helped. Thank you.